For today's Business Matters, we have Don Ma here with us. Don, it's good to see you. How are you? What's new?
Yeah, I'm doing well. How about you guys? Great to see you too.
Yeah, can't complain.
What's happening in the world of business, sir?
All right, so let me start off with the port strike here. It's halting the flow of many U.S. imports and exports, entering day 3 here, and a run on toilet paper and paper towels and bottled water as well has followed the strike. But it's unlikely to have any impact on the supply of these products. Most U.S. toilet paper comes from domestic factories, but the strike could affect perishable foods like fruits and vegetables. Beer, wine, and liquor, as well as toys and other durable goods could also be impacted. The International Longshoremen's Association represents 45,000 dock workers. It's demanding hefty pay raises and a ban on automation imports. And the CDC is alerting public health officials and clinicians about the potential risk of counterfeit drug overdoses. Individuals ordering fake prescription medicines from online pharmacies are at risk. The agency says the counterfeit pills sold through illegal internet-based pharmacies often contain fentanyl. This is the synthetic opioid that is the leading cause of drug overdoses in the United States. The CDC says nearly 95% of websites offering prescription drugs online operate illegally. On Monday, the Justice Department announced charges against several individuals operating illegal online pharmacies. Prosecutors allege they sold counterfeit prescription pills to tens of thousands of people in the U.S. The CDC urged patients to be cautious of online pharmacies that operate without a license or do not require a doctor's prescription and offer steep discounts. Now, the U.S. has banned imports from 2 Chinese companies over forced labor allegations. The Department of Homeland Security announced the ban yesterday. The companies involved are a steel manufacturer and a maker of artificial sweeteners. Both are accused of using forced labor from China's far west region of Xinjiang. The ban was carried out under the Uyghur Forced Labor Prevention Act. The law addresses human rights abuses in Xinjiang. It was signed by President Biden in 2021. The list of companies accused of using forced labor under the law has grown to a total of 75 since June 2022. And global bank messaging network SWIFT taking a major step to bridge traditional finance and blockchain-based systems. SWIFT announced that it's going to test live transactions of tokenized assets and digital currencies next year. Banks and asset managers have been exploring tokenizing traditional assets like bonds for several years. They hope that by using digital units like blockchain-based tokens that represent a share of the underlying asset, trading can be quicker, cheaper, and more efficient. Digital currencies have faced criticism and opposition. A poll last year showed only a small fraction of Americans support adopting a central bank digital currency. Now, 250,000 holiday workers will be helping fulfill and deliver orders for Amazon this season. The e-commerce giant announced that it plans to hire 250,000 seasonal employees, even though the company said it expects overall holiday sales to outpace last year's totals. This is the same number of seasonal workers as in 2023. U.S. retailers are dealing with the softer labor market and are expected to add about 520,000 new jobs during the holiday season, a reduction from last year. Now, while robo-taxi test operations are heavily regulated, some Tesla rideshare drivers appear to be exploiting a loophole. Reuters has been investigating this. It first reported a crash in Las Vegas where a self-driving Tesla carrying a passenger for Uber hit an SUV. Reuters spoke with a ride-hail driver and contributor to an online community of ride-hailing drivers who estimates about 30 to 40% of Tesla ride-hail drivers across the U.S. are using full self-driving software. In response, Uber and Lyft told Reuters that drivers are responsible for safety. It's not against the law to use the software as a ride-hail driver. And a senior U.S. Treasury official, Brent Naiman, said the International Monetary Fund is too polite when it comes to criticizing China's economic policies. He believes the IMF should be more direct and transparent, especially about the loans that China gives. And now joining me to discuss this is EJ Anthony. He's a research fellow at the Heritage Foundation. EJ, thank you so much for coming on today. So Neiman raised concerns about China giving out loans. He urged the IMF to push China for more clarity about its lending terms. I was wondering if you could explain to us China's practice of making emergency loans to debt-ridden countries and Neiman's concerns here.
Certainly, this is essentially the practice of a loan shark just on the international stage. What China is basically doing here is going to very vulnerable debtor nations and bailing them out, but using terms that are essentially going to enslave those nations in terms of debt to China ad infinitum. So there will typically be no way for these nations to ever get out from under the thumb of the influence of the Chinese Communist Party. Again, it's very much like the way a loan shark can ensnare an individual into a kind of debt slavery at the individual level, but this is just being done at the international level.
Can you tell us how China is exploiting some of these debt-ridden countries? What are they doing to these countries?
Well, it works very similar to when a person, let's say, takes out a credit card and the credit card starts with a 0% interest rate for a period of time. And there is an incentive for you to go out and spend a lot of money on that card and rack up your balance in the hopes that you can pay off that balance before the very punishingly high interest rates eventually kick in. And what ends up happening for a lot of unfortunate folks is that they can't actually pay off all of that debt. And now they're stuck making those very high interest payments to that creditor, to the bank. In the case of China, very oftentimes what they do is they make countries promise things in the future. So today they get a lot of handouts, maybe some infrastructure development from the Chinese Communist Party, but then in the future they have to pay a punishingly high penalty. Sometimes that essentially requires these nations to hand over a tremendous amount of their natural resources, for example.
So the Treasury official highlighted this point as well, that some of the loans don't always appear on the balance sheet of the borrowing nation. Can you speak to the impact of this lack of transparency?
Well, it makes it very difficult for other nations to have any kind of confidence when they have to interact with these debtor nations to China, especially in terms of international trade. Because when you can't be sure of if your trading partner, let's say, is in some kind of financial predicament, you are very less likely, I should say, to want to trade with those people or to want to have any kind of financial interaction at all, even if you're not necessarily trading products. The result of that is, again, it really hamstrings these nations' ability to interact with others on the world stage, and it increasingly silos them into China's corner. And so it expands China's sphere of influence while diminishing those nations' ability to trade and, again, to interact with other partners or former partners on the world stage.
And I'm wondering, why doesn't China want to adopt the same transparency standards that other creditors adhere to? Because I would imagine if China did that, more countries, I would imagine, would want to take loans from China.
Well, some of it has to do with the fact that when these nations become so terribly indebted to China, if the rest of the world knew about it, then no one else, for example, would ever lend those countries money. No one else would want to deal financially with a lot of those countries, knowing that they're essentially doomed to either a default or, again, just perpetual debt servitude to the Chinese Communist Party. And so the result of that is these nations essentially need that data to be off the books, so to speak. In other words, they need those transactions with China to stay hidden so that they are not persona non grata on the world stage.
So what needs to be done to push for greater transparency from China regarding its lending practices?
Well, one of the ways that has so far proven very successful in terms of dealing with China and trying to get them to not be such bad actors on the world stage in a lot of different matters, frankly, has been tariffs and non-tariff penalties on Chinese trade. Again, that has proven to be particularly successful in the United States. Under the Trump administration, they did a very, very good job of strategically placing those tariffs on certain products and in such a way that it essentially compelled the Chinese Communist Party to stop being such a bad actor on the world stage, to stop undermining American manufacturing, let's say.
But I've noticed that every time a country, places tariffs on China, the country always comes back with a retaliatory measure. I mean, does that deter certain countries from wanting to impose tariffs on China?
Well, it depends on the trading partner with the Chinese in large part. In the case of the United States, we buy so much from China and they buy relatively little from us. It also depends on the alternatives that nations have. And this goes back to the strategic way in which the Trump administration placed tariffs on the Chinese Communist Party. And essentially what they did was they focused on things which American purchasers would have alternative choices. So instead of buying steel from China, they could buy steel from Sweden, let's say, for only a little bit more. That meant that the Chinese steel producer, who was already heavily subsidized by the government there, the Chinese steel producer had to essentially eat the cost of that tariff, because if they raised prices any more than just a little bit, Americans would just buy the Swedish steel instead of the Chinese steel. So again, it goes back to it being a very case-by-case basis, not only country by country, but also individual product by product.
All right, EJ, terrific insight today. Thank you very much.
Thank you for having me.
All right, moving on now. Let's talk about beer. It seems like drinkers appear to be thirsty for Coronas and other Constellation brands. So the beer owner reported that it beat second quarter estimates, and robust demand for its popular beer demands helped soften a slump in its wines and spirits business. A struggle that's been ongoing for several quarters, that is. As for its beers, the company said that it has seen persistent demand in this segment. Its major revenue drivers are the Modelo Especial and Pacifico varieties. The company says consumers continue to spend on its light-bodied beer categories. Now, luxury meets speed. Formula One has announced a 10-year partnership with luxury brands group LVMH. In a joint press release, Liberty Media-owned Formula One said LVMH will become a global partner next season. That's when the motorsport celebrates its 75th anniversary. The decade-long deal will include hospitality, limited editions, and outstanding content with Louis Vuitton and others. The two teamed up last year for the Las Vegas Grand Prix. More partnership details are expected to be released next year. Now, consumers often sign up for streaming services like Netflix, for example, and Hulu just to watch one particular show and then promptly cancel their subscriptions. This can be a problem for the streaming platforms. NTD's Sean Marshall speaks with an analyst on how some balanced programming might help.
One-and-done TV shows can be great for attracting video-on-demand streaming service subscribers. Highly popular shows like Reacher, True Detective, Shogun, and Halo have a high rate of subscribers that quickly cancel service after watching them. And that is what Wall Street wants rewarded.
But ever since about mid-2022, when Wall Street kind of did a 180 on the streaming business model, raw subscription growth is no longer the best indicator of streaming success.
Analyst Brandon Katz stated in his Observer article that the high occurrence of one-and-done subscribers is a critical element missing from the programming strategy of acquisition versus retention.
That requires immense resources for these big, huge, splashy shows, your Stranger Things, your Mandalorians, your Lord of the Rings is. You need to have that balanced with a strong library of retention-driving content.
Katz says there's a problem of trying to hold on to those high-risk subscribers prone to canceling service. Something that can retain customers is a library of classic established favorites. But that's not all.
Push users with very, very creative algorithmic recommendations and discovery tools slightly outside their comfort zone in order to extract the full value of a streaming library.
Some highly popular TV shows have a high percentage chance of retaining customers. These TV shows hold on to subscribers the most, according to Samba TV's State of Viewership Report. Netflix's Captains of the World is rated the highest for retention. 47% of audiences that watched this show watched another title available on Netflix in the US. Then Max's Property Brothers, Buying and Selling at 45.7%, followed by Hulu's Dance Moms, Amazon's Dahad, Disney Plus's Marvel's The Defenders, Peacock's Winter House, and Paramount Plus's FBI International. Sean Marshall, NTD News.
All right, and just quickly before we go here, let me recap markets for today. So it looks to be all red down at Wall Street. S&P 500 losing nearly 10 points here, about 1/10%. The Dow here, 184 points in the red and down just around 0.4%. And the NASDAQ minus 6.6 points, and then nearly unchanged in terms of percentage. And with that, all that's happening on Business Matters today. And back to you guys.